Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan interviews Rudi Fronk, chairman and founder at Seabridge Gold.
And Corey and I pretty much have to talk about GDP numbers, core PCE numbers, and what we think the Fed will do because that's what we're obsessed with.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. So make a prediction for me. When will we stop obsessing about the Fed? We'll stop eventually. I'm confident of that, but I don't know, a year? Like, what would it take? 3% Fed funds? I don't even know.
A really bad recession followed by cutting rates and people freaking out and then getting out of the market and everybody moving on from inflation. And maybe that will be it. Or when they go away completely. Well, definitely. That would be the case.
Boy, that sounds like a lot of fun, doesn't it?
Yeah. Sorry. What do you think?
I think that we're going to have to sit down in front of the microphone one day and say, this is it. We're not doing this anymore. It's just going to have to be cold turkey. Like right when everyone expects us to talk about it, we'll just start talking about other stuff. But until then, we got to talk about, GDP came in pretty kind of hot. I think the expectation was like 4.5, and it came in at an annual rate of 4.9% real gross domestic product in the third quarter of 2023. That's a warmish number. It's like there's no recessing there. I mean, incomes were down or, not up as much, actually down in real terms. So, that's not great. But this measure of economic activity is en fuego.
Yeah, it was double what the rate was, analyzed the previous quarter in the second quarter. So, if you're looking at that, you wouldn't say a recession is afoot. And consumer spending, the PCE numbers that you mentioned, also were pretty good for September, like 0.7% for the month, which is pretty large.
I thought that was pretty hot too. Yeah.
Yeah. So, I mean, these are looking backwards, right? So third quarter, September, but it just shows you what has been happening. And if the consumer spending end was still holding up for the last couple months, there's a lot of questions about where it's going to be in the future. But for now, it's still holding up. Now, what that means for the future, I don't know. But for now, it's okay, I suppose. Although you wouldn't know it by looking at the markets recently.
Right. So they break down the personal income stats in the GDP report. Current dollar personal income increased, well, let's just call it $200 billion in the third quarter compared to $240 billion in the second quarter, right? So down. Disposable personal income was up $96 billion or 1.9% compared with 6% in the second quarter. Real disposable personal income decreased 1% in contrast to a 3.5% increase. So, I mean, even by these backward-looking numbers, there's potential for some sloth.
Right, and we've seen that in other numbers too, like, the credit card numbers and that sort of thing, which are
auto loan,
to me, alarming at this point. Yeah, auto delinquencies and picking up. So I don't think if you ask most people, like, on the street, like whether things are going great, I don't think they would. I would think they would say inflation is, I'm making a broad-based statement. I think they would say inflation is still pretty strong and my pay is not going up, is what I would suspect. So make of that what you want. It's not, that's been going on for a long time, but it seems to be really stretched right now.
Yeah. So if we think about this, everybody wants to know, what will the Fed do next? Will there be a hike? Will they stick? I mean, the market seems to be saying they'll stick with the current range, top end of the range, 5.5%. And that, the long end of the curve coming up has effectively, hiked, right? That's
right. I've heard that a lot. Done the work for them, right? Done the work for the Fed in terms of tightening. Yeah.
But I still, I remain, and I have all through the rally, so I admit, my wrongness. But I have to remain really bearish on equities because, people look at that 4.9 and say, oh, the economy's great, so the stock market's going to go up, right? That makes sense. When equities, like what you should think of is GDP, bond yields, and equity returns all rising together. And when yields and returns rise, bond prices and stock prices fall, right? So, when the economy is really on fire, the bond yields go up, so bond prices fall. And that creates a knock-on effect, especially, other things being equal, there's a knock-on effect in the stock market, but especially when equities are still at mega bubble valuations, still at 28K, north of 2 times sales on the S&P 500. I mean, we're still in expensive territory here.
Right. And I think what we also forget is, a strong economy is an incentive for the Fed to loosen anything anytime soon.
Right.
We still have unemployment while it's ticking up. The overall rate ticking up a little bit has not gone through a terrible, decline yet. I mean, in terms of job losses, the unemployment rate hasn't spiked yet. You got 4.9% GDP. We know what the Fed does. They're always late to everything. So if they're looking at this and saying, oh, the economy is still okay, despite whatever stories we may hear about people stealing all different things from dollar stores and whatever it may be. If we know anything about the Fed, we know they're probably going to do the wrong thing, or the thing that should have been done 6 months ago. So what's also interesting, I saw this last night on X, formerly known as Twitter, was in 2007, the fourth quarter GDP was, what do you think it might have been?
2007?
Right before the big crash, 2007.
Oh, I don't know. Top of my head, 4.9.
Exactly 4.9%. Right before everything went to crap, right? Okay. In 2000, there was a 7.3% GDP right before the bubble started bursting. So make of that what you will. I mean, it's the point is, I think strong economies come before bad economies when the Fed decides to trigger a recession.
Yeah, a little bit of Thanksgiving Day turkey dynamic there. Fat and happy until you get your head cut off. Yeah. All right. Well, I don't know. I don't know if I have much to add to all this. I'm still got to be bearish equities because they're just way too expensive. And I think we've been through the most massive mega bubble in all recorded history, et cetera, et cetera. All the stuff you've heard me say a million times. Still saying it.
Right. And you look at it now, we've been kind of tracking different indicators and whatnot. And the S&P 500 has just recently gone below, its 200-day moving average for a couple of days in a row, which not great things tend to happen when that happens. And, we've the Magnificent Seven leading the stock market higher. It's becoming very clear now that has been the case. If you look at equally weighted indexes are down at lows for the year. So yeah, it's been a tough couple months. I wonder if this is the extent of, I see why you're bearish on equities. I wonder if this is the extent of this part of the sell-off we've seen the last couple of months, but we'll see.
Yeah. Well, every decline is just another buying opportunity, right? Every dip is just another buying opportunity, right? That idea isn't beaten into us for, well over a decade, really a couple of decades here. I worry about that. I worry about people thinking every decline is a buying opportunity.
Yeah. I mean, I wouldn't be blindly buying dips as you've written recently in the digest. I mean, if you're going to be buying, you got to be selective and not just buying every 5% dip.
Yeah, that's getting harder. And, it's not just, you mentioned the equal weighted indexes underperforming. And actually the Magnificent Seven are all down, even Microsoft, since the market topped out on July 31st. And I think 5 of them are down double digits since then. Like, okay, maybe they're done now too. And, if so, boy. And our friends over at Sentiment Trader, I've quoted them in the digest recently, they're finding all kinds of things. Like 6 of the 11 S&P 500 sectors have more than 50% of their stocks in a bear market. Every basic material stock, every stock in the basic material sector, highly economically sensitive, in a downtrend. And just a couple of their headlines: NYSE stocks are losing their long-term uptrends. And the first year of this bull market has been unlike any other, meaning if a new bull started a year ago in October, this one looks a little different.
I would agree with that. I keep remembering, small caps. Yeah. I mean, small caps have gone nowhere for almost a year.
Yeah.
So it's that's not a sign of a new bull market.
Yeah. So anyway, we could probably pile these things up and make ourselves feel really wonderful about being bearish, but you get the point.
I do think eventually, and this is something, if anybody has seen our emails and marketing lately, that our founder Porter Stansberry mentioned in his presentation last week, like eventually, if this recession happens, which he thinks it will in a bad way in 2024, like eventually this will create good buying opportunities, that are worth it. Like I'm looking at, in good companies, I'm looking at Hershey right now, which is no secret. That's been a favorite around here for a long time. Down, I've been watching this for a while. It's down 30% since April. Like you would not think that would be happening right now, but it is. And that's something I've been watching. Now, Hershey was also up throughout all of 2022 as a kind of a defensive stock, I think. But now it's down. I mean, that's a signal to me that there's some lowering of expectations for the year ahead if a company like that is down 30%.
Yeah, but Corey, that stock and others like it are being hit by this weight loss drug sort of panic in the food stocks. And
right.
Which ultimately I don't think that affects Hershey very much. And I don't know. We had David Cervantes talking about this at the conference in Vegas last week, and I don't know. It looks like all the stocks you'd buy to sort of ride it have kind of moved quite substantially. A couple of pharma stocks like Novo and Lilly have really cooked. And I don't know, there's just something about it. Like I'll have to see it to believe that it's that big of an effect.
Yeah, me too. When I first started seeing those headlines and like analysis, I was like, really? Like the airlines were saying like they're going to get a boost because people are going to be way less. That one seems a bit of a stretch to me. I don't know. So yeah, I guess that's my ignorance there on the impact for Hershey's shares. But again, if somebody's going to beat down the stock for that, then it could be a good buying opportunity. I mean, they make plenty of different products. They'll be fine, I think, over the long run. So maybe the time is now for that particular stock.
Might be. I mean, it's like 20 times. The PE is like 20 right now.
Right.
Which
anyway, my point was, in a big, significant downturn, there will be buying opportunities like this. I think for the longer term, that at the time, of course, it will feel like you should be panicking, but you really shouldn't be. I think. Yeah. At that point.
Yeah. All right. Well, enough of this bullish, dire talk.
Do we want to say what the Fed's going to do? Oh, sorry.
Yeah. What are they? I don't know. I mean, I thought they were going to stick. I mean, the market thinks they're going to stick. I think it's probably right.
I think so too. And then maybe one more 25 basis point hike by the end of the year, like they've said for a couple months was the plan.
Right. So. And, data dependent. We'll see, between now and then, lots of data comes out and it could change that. So I think, 5.5% it seems like enough to, it seems like it's starting to be enough to do whatever they want to do. And it's enough to make investing almost normal again, in my viewpoint. So, yeah, we'll see. I'm looking forward to how the next couple of months develop. I'm afraid that it could get really crashy. But who knows? If it does get really crashy, maybe in a couple of months we'll be really bullish on the show, huh? That'd be fun.
Yeah, if I will. When it happens, I will. I'm prepared to do that.
Yeah, as am I. So on that note, let's talk to our guest, Rudi Fronk. Full disclosure, folks, we talked to him last week in Vegas, but we've talked to him all about his company and his career and, the assets that his company, Seabridge Gold, owns. And it really was, with one of the top guys in the business. At Stansberry, we've known Rudi for like 20 odd years. I mean, since the beginning practically of the business. So we know him well, and he's just a really great guy, a great mining entrepreneur. And let's go ahead and talk with him. Let's do it right now. The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2023.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2023.com for your free copy of my new report. Okay, Rudi, welcome to the show. I'm glad you could be here and talk with us.
Delighted to be sitting next to you, Dan.
All right, so let's see. You are not really new to Stansberry subscribers. However, our podcast listeners are not necessarily all in that group. So I want to familiarize our listeners with you and with Seabridge, and the company that you're well known for. So maybe you could talk a little bit about Seabridge, and then, and we'll talk a little bit about, deposit quality and all those good things that we need to know with a mining company.
Great. So I'm a mining engineer. I've been in the business for over 40 years. I built mines around the world. I've had mines expropriated around the world. Political risk is real in our space. In 1999, my colleagues and I took a look at the gold market relative to other financial assets and decided it was a good time to get into gold. Gold was trading at about $260 an ounce back then, and we believed that over time it would go substantially higher. And our goal was to create what we thought would be the best leverage play to a rising gold price in a public company. And we've done that quite simply by going out and growing ounces in the ground faster than shares outstanding. The thought being that the more gold that we can provide on a per share basis, the better our share price should do if the gold price was going higher.
I've learned to love the leverage of well delineated ounces in the ground, not just for gold, but for copper and other things as well. And I assume, and you obviously love that too. What's good about that?
What's good about it is, number one, we're not mining. Actually, building and operating mines is a big challenge. I learned that in my career. And it's all about optionality and leverage to a rising gold price. Now, I fully understand that an ounce of gold in your pocket is worth more than an ounce of gold in the ground. And that comes next in our business strategy as we transform our large project in British Columbia into a producing mine through a joint venture with a major mining company.
Okay. And the large project is approximately where in British Columbia?
It's northern British Columbia. Mm-hmm. It's what's an area called known as the Golden Triangle, right next door to the Pretium deposit that was taken over by Newcrest recently, and just south of 2 big projects that are in place with Teck and Newmont. Now,
as I recall, correct me if I'm wrong here, there were some interesting issues with the Pretium deposit for a while. There was something about the use of certain statistical measures to identify the gold in the ground there. Yeah. Now, I don't necessarily, so you're laughing and nodding, so I assume I'm on the right track here, but I don't necessarily want to get into that. I just want to know if, the Golden Triangle sounds wonderful. So that was just an issue with that deposit and how they were trying to delineate it, right?
Yeah, that was the epithermal top of a porphyry environment where you have a lot of variability over short distances in grade. Mm-hmm. So you can drill a hole here, drill a hole 10 meters away from there, and you're trying to predict the grade in between. But there's such variability that you could be wrong. And in the case of Pretium, I think their original estimate was 15 grams per ton, and they're actually mining 8 grams per ton. Our project at KSM, it's in the actual porphyry environment where you have much lower variability over large distances. So you look at what's known as variograms, which determines how close your drill spaces have to be able to forecast grade.
Okay, so my limited knowledge of deposit structure is that the really good ones, many of the really good ones, are kind of mushroom shaped. You know, you get this sort of stalk and then it kind of spreads out over the top. What is the general shape of the KSM deposit?
We have 5 deposits at KSM. Okay. we call it a project that's really a district. Okay. And 4 of the 5 deposits have over 2 billion tons of economic resources. Wow. These are massive deposits that host not only gold, but also copper, silver, and molybdenum.
Okay, gold, copper, silver, molybdenum. In like, what's the main metal that you go after? Do you just, are they all in equal proportions or what?
Each deposit is different in terms of gold versus copper makeup. Mm-hmm. The pre-feasibility study we now have completed with the mine that's permitted focuses more on the higher grade gold deposits. Mm-hmm. So if you look at our mine plan, that gives you 33 years of mine life now. That's probably 70% gold, 25% copper, and then some silver and some moly.
And no mining taking place at all, or
at this point in time, no. One of our guiding principles, which comes from my experience in the past, is we will never build a mine ourselves.
Good for you, because I've seen people do this thing where their business model kind of morphs. And, I thought they were one thing, and then, a few years later, they say, oh, we're going to put all our capital into this one flagship project. And, that's when they've sort of screwed the model, and it's not a good thing to see it. But, I applaud you for sticking to your guns and not getting into mining.
You think as a mining engineer I should, but I've learned the lessons the hard way.
Yeah.
So our goal instead will be to bring a major mining company in as a partner to co-develop this asset, where they'll do all the heavy lifting, and we'll retain somewhere between a 40 to a 49% interest in the project as they spend most of the capital to build the mine.
Yeah, we being Seabridge.
Seabridge, correct.
Yeah. And Seabridge is the ticker still SA?
SA, I'd say it's South America, but the SA actually comes S for Seabridge and A for the symbol for gold. I couldn't get SAU.
Oh, okay, darn it. All right, so SA, Seabridge. And when did you start Seabridge? How long have you been doing this?
Formed Seabridge in October of 1999. Okay. I had not yet turned 41.
Oh, good moment.
I'll be 65 next month.
Good timing.
So this has been 24 years of my life dedicated to building value for shareholders.
Yeah, wow. And gold in 1999, wasn't it still like 250 or something?
Correct. It was a great time to be buying assets. Yeah. I personally believe that the gold industry as an industry could be the worst allocators of capital of any business on the planet.
Yep.
You look at the major mining companies, they do all their deals at market tops, they overpay, and then when the market goes against them, that's when they're selling non-core assets for pennies on the dollar. That's what we did. From 1999 to 2002, we scoured the portfolios of the major mining companies. We wound up buying 9 deposits. These 9 deposits initially gave us 15 million ounces of gold in the ground. The previous owners had spent over $300 million defining and we bought them in the aggregate for $15 million.
Whoa. That's
misallocation of capital by the majors.
A bit of a discount to the original. I'm not saying that was the original value, but it was the original price. Yeah. That's pretty typical. Rick Rule makes the point often that the gold industry on the whole, I forget the period in time, it was a couple of decades at least, it produced 0 free cash flow. They consumed capital during the period. And it's always been a highly cyclical thing, isn't it? All resources are like that. It's sort of normal. I hate to say it.
Agreed. Gold is a bit different in that, it's not annual supply and demand fundamentals that determine the gold price. Mm-hmm. It's what is gold worth relative to other financial assets. It's a very different, because every ounce of gold ever mined from the beginning of time is really available as supply today.
What is gold worth relative to other financial assets, Rudi? I'd like to know that myself.
That's a good question. I know I've heard some people talk about the price of gold should equal basically what you would go and buy a very expensive tailored suit for. Mm. I hear the argument in the U.S. it's a handgun. That's what it should be, the price of an ounce of gold.
Let me tell you something. $1,800 will get you a nice handgun.
Yes, it would. Maybe not too much of a nice suit anymore.
No. I've bought rifles for that were really nice.
Our view is that with what's going on in the world today, the price of gold is going to go substantially higher. Matter of fact, we're forecasting that by the end of this year, which is only a couple of months away, that gold will will break through and be above its all-time high, which was about $2,063 an ounce. And then over the next few years beyond that, we're going to see gold trading at multiples of where it's trading at today.
I'm real curious about the inputs in the forecast. I mean, we're talking near term. You've got very little time for this thing to come true. So I'm really curious about the inputs.
Well, I think we believe that a recession is inevitable, but that's not what's going to drive gold. It will at some point, but I think the canary in the coal mine right now is the Treasury market.
Yeah.
When we look at the amount of treasuries in the U.S. that have to be purchased next year, you add it up, it's $10 trillion. Historically, Japan, China, and Europe bought those treasuries. They're now sellers. You had commercial banks buying for a while. They're no longer buying because it almost blew up the banking system. The buyers of the treasuries right now are hedge funds, and they're using tremendous amounts of leverage to build positions. Remember long-term capital management?
Yeah, geez.
Well, what could possibly go wrong?
That's right. Highly levered, they were doing that on-off-the-run treasury trade. What could possibly go wrong? Yeah.
So our view is that the Fed's going to actually have to come in and be the buyers of treasuries because the rest of the world is not doing that. Right. And when that happens, that's when gold catches a bid that will be hard to believe.
Well, I almost want to say, gosh, I hope not. Rick made that point from the podium in Las Vegas when he was there and at our conference. And it's true, isn't it? We really don't want all this to happen, but its inevitability allows Rudi Fronk to have quite a career.
Well, career and also hopefully a nest egg. I've got 95% of my family's net worth in Seabridge common shares.
Wow. Skin in the game. Skin in the game has become a thing since Nassim Taleb wrote a book of the same title a few years ago.
It's been my baby for 24 years. I've got fortunately, I have a very patient wife. Mm-hmm. I mean, if you look at the history of our share price, started out at about 10 cents per share. Steve Sugarwood recommended us in 2002 at $2 a share. It was Steve's best recommendation ever in his career, going from $2 a share to over $20 a share. Returned to Stansberry readership of 995%. It was on number one on the Wall of Fame for a number of years at Stansberry. It's topped now down with cryptos. Then we went from high 30s down to single digits again, and then high 30s again. And then coming out of 2011, when gold went from 1,900 down to 1,050, our share price went from high 30s down to single digits.
So ultimately, you're maybe going to wind up, maybe you get some more gold price appreciation, which gives you, equity price appreciation, and sell it to a big mining company, sell the whole thing lock, stock, and barrel to a big mining company?
No, our preference is a joint venture. If you look at KSM today, with the mine plans that we have in place, we can show a mine that's going to produce over 1 million ounces of gold a year for 33 years up front, and that's only capturing about 20% of the known deposits there. But that mine will have an all-in cost of production of about $600 an ounce, including all of the upfront capital, the sustaining capital, the closure costs, and the operating costs. The industry today is making gold at $1,300 an ounce. The first 7 years of mine life at KSM at today's metal prices generates over $2 billion of free cash flow a year. If we can hang on to 40 to 49% of that in a joint venture, that's a big number relative to our market cap today. Give me a multiple on that, and that's why John Duty at the Gold Stock Analyst has a $75 target price on our shares, when today we're trading at $11 per share.
Wow. What's the market cap now?
About $1 billion US.
About $1 billion US. Wow. Wow, I didn't know that about John. That's a big call.
It's been a 24-year overnight success.
Yeah, 24-year overnight success.
Well, John looks at it. So think of it this way: if you ignore our copper, ignore our silver, ignore our molybdenum, we have 170 million ounces of known gold resources in the ground. We have 83 million shares outstanding. Each one of our shares is backed by over 2 ounces of gold in the ground per common share. At $11 a share, it means we're trading at about $5 or $6 per ounce in the ground. If you look at all the metal we have in the ground, on a per share basis, it's over $6,000 per share. The gold, the copper, the silver, and the moly. That's where the optionality and leverage comes from. But more importantly, when these ounces start coming out of the ground, it's going to really create value to our shareholders in terms of cash flow and gold flow.
Yeah, and just for our listeners' sake, the really great parts of the mining investing spectrum are what Rudi is talking about, plus at the other end, like a producing royalty would be a great thing. It's a one-time CapEx, a one-time investment, and then you're never on the hook for expenses or CapEx. There's a little expense, but you're never really on the hook for expenses or CapEx ever again. And that can be wonderful. We've seen that produce wonderful returns. But we're back at the sort of earlier end with you.
Correct.
Looking for ounces in the ground. It's a wonderful thing. So would you call yourself, I've covered Altius Minerals, a well-known prospect generator, which is at both ends, right? They're generating original prospects, retaining a royalty, and every now and then a mine gets built and they have this wonderful stream of income. What do you call yourself in that spectrum?
How about a gold hoarder?
A gold hoarder, yeah. Yeah, we've seen other people do this too, with copper and other assets over the years.
No, it's been the business plan from day one. So we took advantage of those early years from 1999 to 2002. We bought a bunch of assets. We grew those ounces and pounds of copper through exploration. Funny thing happened in 2015. Valuations got decimated again. Gold went from 1,900 a few years before that to 1,050, and equity values got destroyed. We backed up the truck again starting in 2015 and have now completed 3 new acquisitions to start round 2 of gold hoarding by buying earlier stage project with known mineralization, and we're now starting the drilling programs to start to define reserves and resources at our new projects.
All right. So what percent is KSM of everything you own?
Probably right in terms of market cap, probably 99.9.
Okay.
In terms of gold in the ground, probably about 90%.
Okay. And at this point, do you still drill it? Are you still delineating the resource?
No, I mean, we now have, with 11 billion tons of known resources, we actually can show a mine life that goes for 200 years. Mm-hmm. And there are targets there to go after, don't get me wrong.
Which is insane, by the way, 200 years. Yeah.
But why drill off more material unless you can convince yourselves it's going to be much higher grade? Mm-hmm. If it's not, and it's likely not to be, it's likely to be very similar, adding mine life beyond year 200 doesn't make a lot of sense.
Okay, so if I went there, what would I see? Is anybody there doing anything? I'm just curious how this all works.
Funny you should ask that question. So, we've been talking about a joint venture for a number of years. Mm-hmm. I think one of the reasons why we trade at the valuation we do is because we have not yet achieved that joint venture. One of the stumbling blocks over the past few years is we have this project now permitted. Those permits were good till 2024. Mm-hmm. Because of COVID, we got a 2-year extension. As we had partnership discussions, any large company was really hesitant to put dollars into a project knowing that the permits could expire before they really got going on the project. So in late 2021, we decided to go raise dollars ourselves to ensure that the permits don't expire. There's a concept in British Columbia known as substantially started, that if we can get that designation, our permits are then good for the life of the project. Oh. So we went out and raised $375 million in 2 tranches, using the project itself, where the secured notes we issued to raise these dollars convert into royalties at commercial production. So it's debt that doesn't have to be replaced. It's a 1% charge against the project for the last royalty deal we did, but it also provides the capital for construction. By the end of this year, we will have over $300 million expended over the last 2 years on early site construction. We're building camps, we're building roads, we're building fish compensation areas, we're tying into the power grid, and we're building bridges. Okay, and does Seabridge have revenues? No. No revenues, so you must have a slug of cash at this point. We our last reported quarter end, we had about $200 million Canadian in the bank. Okay. We'll spend a chunk of that by the end of the year. We are fortunate that we have a shareholder base that year in and year out has continued to support us. I think we've been very disciplined with our share count. When I look back at the 24 years at the company, I sometimes pinch myself. How do we only have 84 million shares outstanding today after doing what we've done, building this asset base, and now doing the work we're doing on the ground? Again, you look at the mining industry as a whole, the amount of shares that get issued by these companies without offsetting that dilution with value is remarkable. And I'll point to the biggest companies in the world as being the biggest culprits of that. Look at Newmont. Over the past 15 years, their share count has gone from 300 million shares outstanding to 800 million shares outstanding. Yet they have less reserves today, maybe not after the Newcrest acquisition. They'll also have more shares outstanding then, but they have less reserves and less production than they did back at 300 million shares. Same thing with Barrick. They've gone from 500 million shares to 1.8 billion shares with less reserves today and less production. Their per share metrics have been destroyed. And that's why the major gold companies have underperformed the gold price in a big way over the past 2 decades.
So don't buy those.
No, I don't think so. Short those and buy Seabridge.
There you go. Short the big ones, buy Seabridge. I don't know if I would short any of them because if the gold price gets going, when the wind blows, even the turkeys fly. So. The man who predicted everything from the rise of inflation to the death of the 60-40 portfolio is stepping forward with the clearest and boldest prediction of his 4-decade career. It all boils down to a single stock, and it has nothing whatsoever to do with artificial intelligence. Former Goldman Sachs trader Dr. David Eifrig believes anybody confused by the current market conditions needs to hear his story immediately. Many of America's best-known investors already bought shares, including Paul Tudor Jones, New York Mets owner Steve Cohen, and Jim Simons, the man the Wall Street Journal named the world's best investor. People in the financial world know Doc Eifrig as the man who went on 3 separate winning streaks of over 100 winning trades in a row. But today, he's zeroing in on just one company and wants to hand you its name and ticker symbol at no cost. In fact, he believes every American should own this company, and soon. To get the full story free of charge, simply go to docprediction2023.com. Again, that's docprediction2023.com. All right, so that gets us up to where we are now. You're looking for this joint venture for KSM. And is there another project that you think has this enormous potential? Like, I assume at some point in the beginning, KSM was not seen to be practically a district, right?
No.
Yeah. How long would you say it went from being a deposit to a kind of a mini or real district?
We did our first exploration. We bought the project in the year 2000 from Placer Dome. Placer Dome had spent $25 million at KSM before we bought it, and we bought it for $200,000. We did not do any work at KSM until 2006 with our first drill program. But prior to that, we actually were working in another project called Courageous Lake in the Northwest Territories, where we grew that deposit from 5 million ounces to 11 million ounces and did a pre-feas on that in 2012. That unfortunately at that time showed a marginal project. A big part of that was the Canadian dollar was essentially at par with the US dollar, which is not good for Canadian assets. Our costs are in Canadian dollars, our revenues are in US dollars. So we shut that project down because we were really advancing KSM in a big way. We are now back at Courageous Lake. We'll update the pre-feas. We'll have that done early next year. We'll be able to show a project that can produce, a little over 200,000 ounces of gold a year for an initial decade at much better capital efficiency than we saw in 2012.
Great.
And there's probably nothing in our share price today for Courageous Lake.
And just for our listeners' sake, pre-feas means pre-feasibility study, which is, well, you tell them. I don't want to.
Yeah, it's not bankable yet, but it's basically done enough engineering to estimate capital and operating costs within a certain variance. Right. And then you build on top of that contingencies to take care of the variance that might exist in your estimates.
How does it go from where it is now to bankable? What's the key variables?
Dollars.
Yeah.
More detailed final engineering with detailed costing.
Okay.
Yeah, not really so much more drilling. It's really more detailed engineering work.
Detailed engineering work, figuring out the economics of a mine that would be built on this deposit?
Correct.
Right. Which you'll never operate.
No.
Which you'll never own and operate.
No, so, it's interesting. People invest in gold stocks because they want exposure to gold. Mm-hmm. Our industry is hell-bent on turning gold into cash and doing a horrible job at that.
Yeah.
If you look at the returns in our industry, it's pathetic. Our goal at Seabridge over time is to take back our share of profits from these mines with a joint venture partnership in the form of physical gold, and then dividending out that physical gold to our shareholders.
Sounds good to me.
That's why we have a loyal shareholder base.
Would you say that, just going back to a minute ago, I've been thinking here as we've been talking, would you say that the real key to not having an out-of-control share count was having this sort of
deeply value-based strategy of waiting for things to go from $300 million to 15 million. I don't see, like, what else could one possibly do but that to avoid?
Yeah, I think it was also the discipline we showed in terms of we were willing to suffer equity dilution if we were able to convince ourselves and our board that that dilution would result in growing ounces per share. And I think it was that discipline that kept our share count as low as it has been. We also took advantage of market tops. I mean, the big companies buy high, sell low. When market environments were strong, we sold non-core assets for cash and kept streams and royalties on some of the things we sold, then sold those later on. We've now probably generated over $75 million in cash proceeds by selling non-core assets that we didn't think we could drive any more value with.
Okay. Interesting. So the real answer is discipline. I mean, the value strategy is important, but the real answer is that ingredient in mining that, people who know what they're doing always talk about, which is people. I mean, is there another industry that has so much, I'm sorry, I just don't know any other word, fraud and waste than especially sort of the exploration end, It's kind of rampant, isn't it?
Yeah, lots of time we're equated to biotech.
Yeah.
We have all these research and dollars that go into the front end before you even have anything to deal with revenues. It's the same thing in mining. A lot of dollars have to be spent before that first dollar comes out of the ground. And most of the projects, quite honestly, where dollars are being spent on, you'll never get any dollars out of the ground.
That sounds bad.
It is bad. Again, I don't have a high respect for most of my industry.
Yeah, there's I want to say a handful of you, but I don't know, I could probably name a dozen of you that are like that. And I've learned a lot. I've been really lucky. I got really lucky meeting Rick Rule early in my career. And I can't tell you, it must be hundreds of names that I've run by him over the years. And he's just always shaking his head. He said, nope, crook, nope, not a bad guy, highly competent, but you won't make any money. He'll make all the money. And one after another, and paper hanger is another name that I've learned to call certain people. It'll be one guy with multiple public entities, and he just happens to be the CEO making money.
Yeah, run away from those.
Yeah, run away. That's right. But you just have one company that you operate in a highly disciplined manner. Good for you, Rudi Fronk. You're a good guy. You're one of the good ones.
Thanks, Dan, and thanks for saying that. And I'm just tickled by the support we've also gotten over the years from Stansberry, not just from Steve Sugarroot, but Brett Eversole made a very nice recommendation from the podium yesterday on Seabridge, and then having John Duty, the gold stock analyst, us being on their top 10 list for a number of years now. So I have a lot of Stansberry's done a lot for me in my career as well.
I'm glad to hear that. I'm glad to hear that we can pick the good actors and tell the world about them. I feel like I did the same with Altius.
Yep.
Some of the best guys in the business, whenever I go to the conferences and I mention, the prospect generator model, Altius has taught me how to think about it. And as soon as somebody says, in other words, flagship project, they're not doing the model right, and I wouldn't know that if it weren't for them, that one simple thing. And when I do talk to people who know, the name Altius always comes up.
It's funny you should mention Altius. I attended the Jim Grant conference a few weeks ago, and one of the speakers there listed Altius as one of his top picks.
Really? Yeah. I didn't know that. Or maybe this sounds vaguely familiar, but I don't think I knew. I'm glad to hear that.
Yeah. Jim Grant has been a shareholder of Seabridge for a number of years.
Oh.
First time I met him, it's a great story. So Jim and I were invited to present at this investor conference where one individual brings talent into the room. He wants to hear about different topics. So I was the gold guy, myself and John Hathaway. And I walk in, sitting next to me is Jim Grant. And I walked up to Jim and I said, Mr. Grant, I want to introduce myself to you. I'm Rudi Fronk. And before I could say another word, he said, Seabridge Gold. Grow ounces in the ground faster than shares outstanding. Why hasn't anybody else thought of that?
Yeah.
He said, I've been a shareholder of yours for many, many years.
Yeah, actually, that's a pretty good question, isn't it? I'm painting a picture like the difference between you and everybody else is like they're liars and they're just trying to get money out of me. But let's say that there are plenty of good folks in the industry who would like to do this. What's hard about it? Once you're a good guy and you want to do right by your shareholders, what's hard about this? Why don't more people do it?
Because you need luck.
Oh,
You need luck. There's no question about that. Yeah, I mean, we saw opportunities early on that we thought we can grow through exploration. KSM, the perfect example. When we bought this project from Placer Dome, they had delineated a resource of 3.4 million ounces of gold and 2.7 billion pounds of copper. Our in-house geologists thought there was upside to add another 5 million ounces. KSM today has 150 million ounces of gold. So a lot of that was luck. Now, you make your own luck by going after and recognizing opportunities, but never in our wildest dreams did we think we would have a project of this scale. Today, it sits as the largest undeveloped gold and copper project in the world as measured by reserves and/or resources.
Hey, let's talk about that for a second. So I've learned to listen to words like reserves and resources and, make a difference between the two. What are we calling reserves at KSM?
A material that is permitted and very profitable. So we have 11 billion tons of material available to us to look at in terms of reserves. However, we're only permitted for 2.3 billion tons of tailings. Where are you going to put the material after you process the ore? So we're limiting our mine plans right now by what's permitted. So we actually cap our reserves to that 2.3 billion tons. So of the 2.3 billion tons, our reserves capture 47 million ounces of gold and just over 7 billion pounds of copper. But there's a lot more gold and copper in the ground that over time will be mined.
Okay, and is this so-called 2P?
2P, correct.
Proven
and probable.
Probable.
Actually, I think 60-something% of our reserves are proven. If you look at the industry, that's a lot higher than you would even see at Newmont and Barrick in terms of percentage of reserves that are proven versus probable.
Okay, and I'm sorry, I just want to get the numbers right generally. Is that 60% of 150 million?
No, 60% to 47 million
of the
reserves.
Okay, gotcha. Of the reserves, I see. The 150 million is like a resource.
It's a resource.
Right. Okay.
It's a constrained resource that had economics applied to it to show that it could be economic, but it's not yet at pre-feasibility study level.
I find this interesting because these are like, probabilities. You're saying, well, 2P is higher probability, and then the 150, this massive resource is less probability, but enough to, how does one say, get excited about? I mean,
do you remember BRIEX?
Oh, yeah.
So BRIEX changed the game in terms of how companies have to report resources and reserves. There was a whole national instrument in Canada called NI 43-101
Oh, yeah.
that now dictates what a company has to do to be able to define reserves and resources. So at least there's some structure to it now. The problem is that any person that can call themselves a qualified person can actually do those calculations. I can give the same set of data to 3 different guys, and I'll get 3 different answers. It's still a lot of, I won't call it guesswork, but a lot, what are you going to allow your search distance on drill holes to define measured versus indicated versus inferred or proven and probable? There's still a lot of moving, and even in the case of engineering studies, you have 3 levels of engineering studies. You have a preliminary economic assessment, where you're allowed to use inferred resources in that calculation, which usually makes projects look a lot better than they really are. Then there's a pre-feasibility study where you actually start defining reserves because you're only allowed to look at measured and indicated resources to become proven and probable. And then there's the bankable study. And it's amazing if you look at the history of these studies as they move up the food chain, capital costs, operating costs, and contained metal go in the wrong direction.
Oh, yeah.
Because the preliminary economic assessment was too, what's the word I'm looking for?
Optimistic.
Correct.
Simply put. And I invite listeners to sort of Google all these terms. We don't want to sit here and try to become a glossary for you. Just Google them. They're all very common mining terms: measured and indicated, inferred, the PEA, preliminary economic assessment. You can learn about them in 5 minutes. So, Rudi, I think we're at a period here in time where I can ask you my final question, which is the exact same question for every guest, no matter what the topic, even if it's not a financial topic. And that is, if you could leave our listeners with a single thought today, what would you like to leave them with?
Being the CEO of a gold mining company, I'll be a bit promotional here.
Feel free.
If you believe in higher gold prices, or if you want to have exposure to higher gold prices as part of a balanced portfolio, Seabridge Gold has a 24-year track record in delivering outperformance relative to gold and other gold equities. If the gold price is going higher, own our shares.
Period. Boom. Very simple. Thank you for that. And thanks for talking with us today.
Thank you, Dan. Great to be here.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.